Welcome back to Module 4. We're going to finish up Chapter 2 in Module 4. When we left off in Module 3, we were talking about Exercise 2-8, and I left you to kind of work it out on your own. I want to spend some time just going over it briefly to kind of make sure you knew what was happening, to explain my approach to it. You may have a different approach. As long as you come up with the same answer, that's fine. What I did on Exercise 2-8 was to start at the end of the year and take my balance sheet equation, assets equals liabilities plus owner's equity. Now I don't know assets, but I do know that it tells me that the liabilities of $320,000 were shown at the beginning of the year, and that they decreased during the year by $18,000. So if they were $320,000 at the beginning and they decreased by $18,000, then I know that they're $302,000 at the end of the year. It also states that my owner's equity at the end of the year was $429,000. Well, if I know that assets equals liabilities plus owner's equity, then assets would have to equal the $302,000 plus the $429,000, which would be $731,000. Now, knowing that, I can go through and do the beginning balance sheet equation, because I now know that my assets at the end of the year were $731,000, and the problem tells me that assets increased by $60,000 during the year. So at the beginning of the year they were $65,000 less. So I take the $731,000, subtract out $65,000. It also tells me that my liabilities were $320,000 at the beginning of the year. I don't know owner's equity, so I can compute owner's equity to be $346,000 at the beginning of the year. Now, I know the beginning and the ending owner's equity amounts. I also know that owner's equity is equal to paid-in capital plus retained earnings. So at the beginning of the year, my owner's equity was $346,000. My paid-in capital was $30,000. By solving that equation, I can find out that my beginning retained earnings was $316,000. I also know that at the end of the year, my owner's equity was $429,000. And I know that my paid-in capital was $192,000. So all I have to do is solve for retained earnings of $237,000. Now, if I know my beginning and ending retained earnings, there are only two things that can affect retained earnings, which are net income and dividends. They give us the dividend amount, so we just have to figure out what our net income was. So we take beginning retained earnings of $316,000, which we computed. We don't know our net income, but we do know that our dividends were $25,000 and that our ending retained earnings were $237,000. Solving for net income, we find out that it was a negative, notice I put brackets around that, negative $54,000. Now that is probably the hardest problem you will have to work in this entire 30 modules that we're going to do. But what it's supposed to tell you is the relationship of the beginning balance sheet with the ending balance sheet, how those changes occur, and how they affect retained earnings through net income and dividends. If you can do that, you're in pretty good shape. So let's take a break from the problem solving for a minute and let's talk about the second part of the chapter, in Chapter 2, where they talk about accounting concepts and principles. Remember earlier we talked about accounting concept statements and the fact that we had the objectives of financial reporting being to provide information to investors and creditors about cash flow so they could make decisions. Well, based on that and in some of the other concept statements there, we have come up with some concepts and principles that play a big role in accounting. We're going to use a bunch of terms in the next few minutes, and I'm going to define each one of them and show you how each of those terms relates to what we're going to do in the next few weeks, how we use those in accounting. So I'm going to switch slides here for just a minute and go into my Module 4 slides and talk about some of these concepts. Let's start with accounting entity. Previously we talked about the fact that when we do financial statements, we do them for one particular entity. We don't mix the owner and his or her firm. We do it either for the firm or for the owner, not for both. not any combined. That's what we call the accounting entity. When we do the statements for the entity, we assume that that entity will continue indefinitely, that there's no foreseeable end to the life of that entity. We call that going concern. We assume that every firm for which we're doing financial statements will continue on forever. We know that's not true, but we know that in the short term they are going to continue. If, however, we see that the firm is going bankrupt or will cease to exist, we have to change how we're doing our accounting. For us, in this course, we're going to use the term going concern to mean the company will go on forever. When we do these financial statements, we have to be able to measure events that are going to be recorded in our transactions to our accounts to our financial statement. The unit of measurement in the United States is the dollar. Now that will change from country to country, of course. The European countries will now use the euro, and certain companies will use pesos and yen. We're going to use the dollar as our unit of measurement. As we produce these financial statements, we're going to be objective. In other words, we're not going to have any bias in our dealings with the transactions. We're going to do it in such a way that there is no bias. When we see a transaction occurring for $20, we write down $20. Related to that is the cost principle, in that if we purchase something, we're going to record it at what we paid for it, not what we think it's worth, what we paid for it. So if you bought a car for $15,000, we record it at $15,000, even though you could go out to, say, somebody's blue book and find it listed for $22,000. That's irrelevant to our accounting principles. We recorded at what we actually paid for it. We're back to that arm's length transaction concept again. In order to do our financial statements, we also have to figure out when we're going to do them. So we set up what we call the accounting period. Remember, an income statement covers a period of time, and a balance sheet is the snapshot as of a point in time. So typically the accounting period that we're going to use in here will be 1 year. And the balance sheet will be as of the end of that year, December 31st, 2005. And the income statement will cover that year, 2005. So the income statement will cover a period of a year, and the balance sheet will be as of the end of the year. That's going to be our accounting time period. Previously we talked about the income statement and the fact there are two parts on the income statement, revenues and expenses. Revenues being the items that we earned, expenses being what it costs us to earn that money. What we try to do on the income statement is called matching. We try to match the revenues and the expenses in the same time period. So if we bought that shirt at Penny's for $20, we want to try to match the cost of that shirt of $12 in that same year. So we match the revenues and expenses in the same time period. So I often refer to the term matching. We're trying to match the revenues with the expenses that generated those revenues. In those revenues, when we get them, we put them in our books. We record them, what we call recording the transactions, in our books using what we call revenue recognition. We recognize revenue. In other words, we put it on the books when it has been earned, we've done something to get that money, and when it's what we call realizable. In other words, we're going to be able to either have the cash in hand or collect the cash in the near future. So revenue recognition relates to when we're going to show that revenue on our books. And we show that revenue on our books when we've earned it and when we've either collected the cash or we're going to collect it in the near future. That's all related to accrual accounting. Remember, like we said earlier, accrual accounting disregards the actual cash flow. It looks at when we earn things and when we had the using up of certain costs, which are our expenses. So the revenues and expenses are not based on the flow of cash. They're based on when we earned them and the expenses we incurred to earn those revenues. So that's what accrual accounting consists of. When we're doing accrual accounting, we look at some additional terms, things like consistency. When we're doing our financial statements, we try to do them the same way each time so that investors and creditors can look at 1 year, 2004, look at the next year, 2005, and we've done all of our systems, all of our processes pretty much the same so that results are comparable, so that they can compare 2004 to 2005. We try to do all our inventory the same way, our depreciation the same way, so that we have consistent results they can compare. Another term that's often used in accounting these days is the term full disclosure. The concept of full disclosure is that when accounting financial statements are produced, that there are no hidden items there. We disclose to investors and creditors and other users everything there is to know about those financial statements. In your textbook, there's a set of financial statements for Intel, and if you look through those financial statements, you'll notice they're the four basic financial statements: balance sheet, income statement, cash flow statement, statement of changes in owner's equity. 4 pages. Then there are probably 30 to 40 pages of explanation for those 4 pages of information. We call those explanatory notes. The notes to the financial statements tell you how the numbers came about. That's part of full disclosure. So the notes in the financial statement disclose how the information was derived. Very, very vast quantity of information often. Some of it's not really readable to a lot of people, but we disclose it. 2 other concepts you need to be familiar with are materiality and conservatism. In financial statements, we use the term materiality in that we don't disclose pennies and nickels and dimes. We only disclose those things that will make a difference in an investor's decision. So often we will use estimates, we will round up. You'll notice that most financial statements are done in whole dollars when you know that they're changed there, pennies and nickels. We round up. It's not material whether it's $5.10 or $5.15 when you're dealing in millions of dollars. So we look at whether it will make a difference to an investor or creditor in determining how we're going to handle it. We look at materiality. Conservatism is the concept that accountants relate in that if there are 2 different ways to do something, you do the way that is most conservative. In other words, it results in the less net income or lower basis of assets. So often there are 2 ways that something could be treated. The accountant will choose the way that is less advantageous, less income reported, less assets on the balance sheet. That's being very conservative. So you can see there's some things that are going on with the financial statements that you may not be aware, you probably weren't aware of previously. But also be aware that this is not an exact science. Accounting does not give you the perfect picture. There are some limitations to our financial statements. We don't include in our financial statement things that we can't measure in dollars. For example, we can't measure the value of the management team of a company, so it doesn't show up on the financial statements. We don't make estimates about things that we have actually purchased. We don't change them for changes in inflation or value. Oftentimes we use estimates in financial reporting in that we estimate how many accounts we won't be able to collect. We estimate the amount of usage we will get out of an asset when we're doing depreciation. So there are some estimates in financial statements. Additionally, we don't report the impact of inflation in our financial statements, which can often have a big role if there's a high inflationary period, as there were back in the 70s. There were several years of high inflation rates. Those were not reflected in the financial statements. So often you will see, if you look at Intel's financial statements, assets added together that were purchased in the 70s, 80s, and 90s, even though there's been a rate of inflation, those numbers are added together. So be aware, there's some limitations to what we're doing. It's not an exact science. As we talk about these balance sheet and income statement items that we've been discussing the last 2 modules, there is a financial statement in your book from Intel, the makers of the chips for computers. As you look through those financial statements in your textbook, notice certain things. You have the 4 basic financial statements: the cash flow, the income statement, the balance sheet, the changes in owner's equity. You have the footnotes, all of those pages of explanatory material at the end of the financial statement. You also have a report from the auditor who says that they have looked at this information and that it's fairly presented in accordance with generally accepted accounting standards. And you will also have a letter from either the Chief Executive Officer and or the President stating their responsibility for those financial statements. So as you look through the annual report, note those things. Some of you may have investments in some different companies. You may work for a firm that has a financial statement. You may want to take that annual report and look through it, kind of, now that you have an idea of what assets and liabilities and owner's equity are, glance through and look at the different kinds of assets, liabilities, and owner's equity that were reported on those financial statements. Okay. So now that we have some basic understanding of financial statements and accounts, let's work through some additional problems in your textbook. Let's start by doing an income statement on our own. So let's look at problem 214, which is in your textbook on the top of page 61. What the authors have given you in problem 14 is a list of accounts. And they ask you at the end to prepare an income statement, a statement of changes in owner's equity, and a balance sheet. Well, what you're going to have to do is take that information they have in the purple box and decide which accounts are income statement accounts and which accounts are balance sheet accounts. Now remember, assets are things you have of value. So as you look through there, you can pick out your assets as being cash, accounts receivable, merchandise inventory, your building and equipment. Pick out the assets. Then go through and pick out the liabilities. These are things that you owe. For example, accrued liabilities, accounts payable, notes payable. Those will be your liabilities. Next, look through and see if you can figure out what your owner's equity accounts would be. Stock, retained earnings would all go in there. That leaves you with your income statement accounts, revenues and expenses. So let's start with those. Let's do an income statement, and we always start with sales on the income statement, and they give us sales as being $150,000. Remember too that the first thing you're going to do after you have sales is deduct your cost of goods sold. They give us that as being $90,000. 150 minus 90,000 gives us $60,000 in gross profit. The only other expense that they list for us in the problem is selling, general, and administrative expense of $12,000, which gives us an operating income of $48,000. They then give us an interest expense of $8,000, leaving us $40,000 of earnings before taxes, and taxes of $14,000 gives us net income of $26,000. So if we know our net income, now we can do our statement of changes in owner's equity. We know our stock is $35,000 and it didn't change. Our beginning balance in retained earnings was $21,500. We just computed our net income to be $26,000, and they tell us that our dividends were $6,500. So our ending balance was $41,000 in our retained earnings account. You add that to the $35,000 of common stock, so your total owner's equity is $76,000. Now you're ready to do your balance sheet. Before you do your balance sheet, I'd like to remind you that you always do an income statement before you do a balance sheet, because your income statement, net income, will end up in retained earnings. So you can't do your balance sheet till you've done your income statement. So we talked about the cash, receivables, merchandise inventory. You add up those three accounts to get your $96,000 in current assets. You had building and equipment of $84,000 and some depreciation that you have to subtract from that $84,000. You end up eventually with total assets of $144,000. Bear in mind that assets equals liabilities plus owner's equity. So if your assets are $144,000, then your total liabilities and owner's equity have to be $144,000. Well, you know your payables, your accrued liabilities, and your notes payable all add up to $68,000. So all you have to do is compute your owner's equity, and you know the total now is going to be $144,000. Your common stock is $35,000. Your retained earnings is $41,000. Sure enough, that's $76,000, so it totals up to $144,000. So that problem was a good review of going through and computing a balance sheet. Now once you've done the balance sheet and the income statement and the changes in owner's equity, the authors ask you a couple of simple questions just to kind of get you to use that information. For example, in Part B, they say, what was their average tax rate? Well, all you have to do there is take your income tax expense, which they gave you as $14,000, and divide it by your earnings before taxes of $40,000. So their average income tax expense rate was 35%. Then they want to know, what's the interest rate on the debt? Well, if interest expense is 8 and they owed $50,000, the 8,000 divided by the 50,000 would give them a 16% interest rate. Then they want to know the par value of the common stock. Par value is the stated value. Well, if the total value of the stock is $35,000 and there's 7,000 shares, you simply divide the 7,000 shares into the $35,000 and you get $5 per share. And then finally they want to know, what's the company's dividend policy? In other words, how much of their earnings do they pay back out as dividends? Well, they paid out $6,500 in dividends on net income of $26,000. So it appears that they pay out 25% of their net income to their shareholders in the form of dividends. That's an interesting piece of information for those of you who are interested in investing in stock. How much does the company pay out of their revenue to me as a stockholder each year? In this case, that's a pretty good return. That's an unusually high return, actually, 25%. So the purpose of that problem was to get you to go through and look at a set of accounts, determine what was a balance sheet account, what was an income statement account, then go through the process of actually doing a balance sheet and an income statement. So that was a pretty good challenge for you. What I want to do then is continue that with problem 18. So if you look right down the page 63 there, top of page 63 there in problem 17, let's get this straight, problem 17, they've given us a partially complete balance sheet. That means they've given us pieces of information and we have to figure out the rest of it. Well, they also give us A through D additional pieces of information. So let's take what they've given us on the balance sheet and the additional information and fill in the blanks. For example, in Part A, they tell you that the records show the current and former customers owe the firm $4,000. But of that $4,000, $600 has been due from more than a year and 2 customers who are bankrupt. You're not going to collect that. So deduct that $600 from your $4,000. They'll give you $3,400 in accounts receivable. So there on the second line of your balance sheet under accounts receivable, you can put $3,400. The second one, Part B, they tell you the automobile which they purchased for $18,000 is new. It's now worth $10,000. They estimate that the car has been used for a third of its potential life. Well, if it's $18,000 car and a third of it has been used up, a third of $18,000 is $6,000. So you'll notice on the slide there that I've listed the automobile at $18,000, but I've subtracted the accumulated depreciation of $6,000. In Part C, they tell you the land cost Blue Company $11,000. It was recently assessed for $15,000. Historical cost, remember we recorded what we paid for it. The land is recorded at $11,000. So now you have all the pieces you need to add up for your total assets. You should get total assets of $27,100. Remember, assets will equal liabilities plus owner's equity. So you know the bottom line on this next slide is going to be $27,100 because it has to equal your asset side. It says in Part D that the company president doesn't know how much the note was signed for, so you really, in the beginning, have to leave off that $2,200. Just put your big question mark there. They give you accounts payable as $34,000. They give you common stock as $8,000. But they don't tell you where the retained earnings came from, do they? So you have to figure out retained earnings. So if you look at note D there in the information, E, since they were formed, their net income has totaled $33,000, and they've paid out $19,500 of that. Well, $33,000 minus $19,500 is $13,500. So the retained earnings is $13,500. So if you add up the stock of $8,000 and the retained earnings of $13,500, that gives you $21,500. That's your owner's equity amount. Your total owner's equity and liability is $27,100. So if you know the difference between $27,100 and $21,500, which is going to be $5,600, that's your total liabilities. Of that $5,600, you know $3,400 is accounts payable, so the remainder, $2,200, has to be the note payable. So that was just kind of a fill-in-the-blank, guess the number kind of question, but it's a good practice for you to see the relationship of the accounts. Remember, assets equals liabilities plus owner's equity. That plays out in the last problem in this chapter, which is problem 18, the last problem on page 63 of your textbook. It actually continues on to page 64 where the real numbers are. They give you two sets of numbers side by side, 2004 and then 2003. Now you'll notice that they're in reverse order, that the earliest year is second, 2003, 2004. I must have the numbers wrong on my slide. They give you 5 pieces of information about net income, dividends, how much the cash went up, the cost of the equipment, the fact that nothing affected land. Then they give you the numbers that are on top of page 64. As you go through and look at those numbers, you can see how they're going to change. If cash went up from $30 to $8, that would be $38. They give you the 126 and the 120 and the 241 and the 230. So you can add those up. And your total current assets for 2004 are $405. On the second part of the assets, you will see that they don't give you land, but they tell you that land didn't change from $25. They tell you the change in the equipment account went up, and they tell you the change in the accumulated depreciation. So you can figure out your total asset accounts there of $620 and $640. Looking on the liability side, they give you everything except long-term debt and total liabilities. You can compute those because all the numbers are given, simply add. Then you get to owner's equity. You have to remember that common stock, they tell you that didn't change, but you are going to have to compute the retained earnings. You know it started out at $190, and you know that the net income was $26 and that they paid out $8. So you can compute your retained earnings for the end of the year. Went from $190 to $208. On these slides you will notice that the numbers are backwards. They should be $204 and $203 instead of $204 and $205. So that completes the discussion of Chapter 2. What I recommend for you to do now is to go back and review Chapter 2 again and perhaps work a few extra problems. If you work a problem and you want to check your answer, just give me an email. I'll be glad to tell you the answers that you should be getting and to help you work through them. I would suggest, for example, that you might want to try looking at problem 19. It's a good review of the balance sheet equation. Thank you.